the usual high standards that they have set all through the years, I would presume that our guest today, Vijay Chandok, who's joining us on Talking Point, would probably be a bit disappointed with how the turn of events has been in Q4. But the questions to him are about whether Q4 and maybe even the whole FY22 was a year of some key pivots, some key investments which might yield results in FY23. And if so, time to take some hard timelines from him as well, because they have traditionally been the highest market share brokers for a long time in India. The advent of a few fintechs has changed those pecking orders, but maybe Vijay has a different strategy in mind when it comes to the long haul for ICICI Securities, and he joins us right now on the show. Vijay, great having you. Thanks for joining in. Hope all is well.
Thank you. Thank you very much. Yes, indeed.
So Vijay, sum this up for us, because every note that I read speaks about the optical numbers, and I presume that for you as well, a 5% fall in revenue QOQ, EBIT margins coming off quarter on quarter, net profit falling about 10-11% is not something that you might have bargained for at the start of the quarter.
Indeed. So look at the headline numbers and you sort of summarized it. Go behind the skin, you look at our business construct, you will find that we have two broad ways in which you can split that revenue. One is the revenue which comes from the issuer and advisory business, the investment banking, the institutional side, which has historically been in the ballpark of 15 to 20%. And the rest of the 80-85% attributable to wealth management, retail, distribution, the whole piece there that we focus on. And that's the area of massive focus for us. Q3 was actually a spectacular period for the investment banking side. I think all the who's who of the fintech world and beyond came and did their IPOs, and you would have seen a very stellar kind of an outcome as far as the investment banking side is concerned. Q4, with whatever happened at the Fed and whatever happened in the geopolitical issues pertaining to Ukraine, etc., did impact the IPO market. Clearly, the IPO market was very muted. So when you look at the headline number and really look at the comparison of the 2 quarters sequentially, and you look at the kind of a degrowth, split it between the two, and you'll find that there is no degrowth actually. It's a flat number when it comes to retail to retail. Are we satisfied with that? I think the answer is no. But what are the areas that have worked well, and what are the areas which are still WIP, as I call it? The areas that have worked well, I think, is retail equities. If you look at retail equities, for the first time, we've started sharing retail equities market share. On a sequential basis, we made a 30 basis point market share gain. So we were at about 9.8%. We've now moved to about 10.1% there. Mutual fund, another area of focus for us, our AUM share increased by 10 basis points, 1.6 to 1.7. SIPs, which is very important and sticky on the mutual fund side, has continued to show traction as we launched our new digital property called Markets app. And today it stands at about 1 million SIPs getting sort of administered to us on a monthly basis. So some of distribution business, the rest of what we do in terms of insurance, loans, fixed income, etc., all these areas have shown growth sequentially and also on a YY basis. In fact, on a YY basis, it's been a 44% growth on all this basket put together. So there are some positives which are, all these, areas that I highlighted. This quarter, market actually saw a relative sort of a muting kind of a performance in most of these areas. The only area which actually did well in the market was actually F&O side, right? The F&O side continued to show growth. Now that's an area where we still have work to do, and probably that's what explains the difference that you see in the market, because there we need to improve our presence and strength. And clearly, the way we have been able to construct an ecosystem for investors on the equity side to make it a winning story for them, a similar winning story needs to be created on the F&O side, right? We started the journey much earlier of creating this winning ecosystem in a digital format for our investors on the equity side, and that is what is sort of getting reflected in gains in the market share that I explained. We completed that. Now we started about, I think, 7-8 months back. We early part of this year, we started work on the F&O side. So it is in a way getting done. There are 4 or 5 big initiatives that we needed to introduce and let that mature into the market so that the traction starts building up. I would say that 70% of that work is done. 30% will probably be completed in the early part of this fiscal. That's when the entire the digital ecosystem required to succeed and win in the derivative, the F&O side, will also be available to our investors. And our expectation, therefore, is that growth will start coming there. So really what explains the difference is you take out the investment banking and you put attention on F&O and you have the whole piece in front of you. All other businesses are doing showing gains.
Got it. Thanks for the detailed piece, Vijay. Now my question is, investment banking, you have virtually no control over per se, right? It is to an extent market determined with your capability as well, but to an extent market determined. The derivative side, I looked at the numbers. So the retail derivative market share, you haven't lost too much ground. You're not ceded too much on a quarter-on-quarter as well, from 3.5 to 3.4%. So I understand that. But the blended derivative market share, despite this 70% work being done, the loss in market share has been there. So is it that the remaining 30% is critical and until then, it's difficult to recoup market share?
So actually, if you look at the institutional side, since you refer to that, that is again a reflection of 2 types of flows. One, which is what you call flow business, which is routine investments that take place by the investors, the institutional investors, and the other, the investors which are linked with IPO style investment and the activity that happens as a result of these kind of investments. In a way, we've seen relatively muted activity on the second part. The activity with respect to the regular side has remained quite all right. In fact, we've recouped good amount of market share that we in a way ceded during the on the flow side. I'm talking about the flow business, the repeat business, which we had actually ceded in Q3 because IPO activity was very hectic. So, I'm not so much concerned about the franchise, variations that are happening on the institution side. My attention is more going on improving the franchise value on the retail side. And, the point that you just said that, 10 basis points or thereabouts that we ceded market share. We actually want to show improvement in market share there because that's a market which is growing and that's a market which we believe will complete the whole story for us in terms of offering to the retail investors.
Yeah, but I also heard you say that in the first answer that you want to expand the institutional piece as well, because what you've done on the equity side, on the retail side, you want to now take it on the derivative side, not just on the retail, but on the insti side as well, if I'm not wrong.
No, I want my investments significantly are on the retail side.
Okay.
The efforts are on the retail side. Institutional side, we enjoy a market share which is, it's something that will keep growing. We don't expect we don't need to make any great any great investments in technology there. The investments there are on relationships.
Got it. Sure. Okay.
Research and relationships.
Okay. Fair call. Couple of other questions. So you've told me in the past that while this overall 1.5 crore addition to the equity side every year is a large enough pool, you might want to be selective, but you also started these digital operations or digitally acquiring customers in a bid to actually up the ante on the customer acquisition side. Now, as I look at the numbers, new clients acquired was about 6.18 lakhs versus 6.76 in 3Q. Is there a reason why there has been this decline, and what's the market share in the active client base? I mean, would you now be at close to 5 or 6 or thereabouts? And what are you doing? And would you want to maintain that position, or would you want to look at profitability over the pecking order?
Yeah. So if you look at the number 6.2 versus 6.7, 6.8 that you described, which you mentioned, in a way is reflective of a reduction that has happened in the market itself. Q3 was a better quarter in terms of total number of customers, demat accounts that got opened compared to Q4. So Q4 came down by what I think 12% or so, 10 or 11% sequentially. So our market share has remained flattish. It is actually closer to 7% on incremental market share when it comes to NSE active. When it comes to new customer acquisition, market share in the ballpark of around 7%. It's been Q3 similar, Q4 similar. Now, what are we doing there? We could have actually grown faster. However, as I mentioned to you in, I think, our earlier interaction also, our focus is on quality, and keeping our attention and focus on quality, we actually muted some of the sub channels of digital, where quality was not coming to our expectation, and we put more attention behind the difficult channels, so to speak, to acquire the organic channels, etc. So this, in a way, I think we are today better than where we were in Q3 in terms of quality of the franchise. I also probably had mentioned in the earlier interaction that the total revenue that we are getting from this pool of digitally acquired customers was neck to neck when it comes to our cost structure. That is now clearly on the north side of our cost structure. Our run rates of revenue have exceeded what we are spending really on the acquisition side of it at a cohort level.
So the entire uptick in cost to income is a factor of the investment. Is the investments that you're doing. The entire uptick in the cost to income ratio is a factor of the investments you're doing, not the customer acquisition cost.
Yeah, if you look at our increase in our cost to income ratio, it is to be viewed in the context of a slightly longer term trend when it was 57-58%, which has come down to about 43-44%. And when it came down to that number, we gave two guidances, a long-term guidance and a near-term guidance. A long-term guidance is that we will come down to about 40%. Near-term guidance is that we see investment, or we see growth opportunities which requires investment. This investment will happen in two zones. Zone one is in technology and related licenses and other spends that we need to do. Zone two is talent and people, specifically in the area of digital technology, cloud, AI, ML, the analytics, and in certain bits and pieces in the investment banking side. So clearly, these are the zones of investment that we are doing, and therefore we said improvement, or rather increase, in operating in cost to income ratio before the decrease. So we are in that increasing mode. We do believe this is probably going to be one more year of where some expansion in cost to income ratio will happen before the retreat starts.
No, sorry. So I maybe my question didn't come correctly. What I mean to ask is, I'm not questioning why the increase as yet. What I'm asking is that this uptick in cost to income has got no correlation to customer acquisition. It's all got to do with capability building.
Largely, I would say largely related to capability building, because that I've described these zones.
Largely, yeah, precisely. Okay. And would you say that despite, so you mentioned that Q4 as a quarter was slow for the industry at large. Would you say there is a difference in strategy? And no one is out here to say the other strategy is right or wrong, and I wouldn't want you to even comment on it. But I'm asking you, is there a difference in strategy which is leading to the growth and the angel ones of the world in the same period that you are referring to, having upped the client acquisition metrics quite considerably? So is it a difference in strategy that they'll be adopting? Ignore the quality part altogether right now. I wouldn't want you to comment on that. It would be unfair.
Yeah. So there are two models that have evolved in the market. One is the model where pricing happens on ad valorem volume of business that you do. Other is on per trade basis, which we call activity-based pricing. We are migrating from an ad valorem model to an activity-based pricing, right? We are gradually deflating our yields, making it more competitive, therefore, and shifting more and more towards the activity-based pricing. Company which the second model that exists in the market is completely activity-based, right? So what is reflecting this difference? Because I said there has been a relatively muted volume, but if activity, number of orders, etc., continue to show a growth, irrespective of the volume in the markets, it gets translated into a revenue growth. So that's the model that they have gone into. That model they chose, most of these people have started off in 15, 16, 17 in that kind of a period. We started this journey in about 19 and a half. We are still WIP in that space, I would say. So that is what is really reflecting, the difference that you see in the outcomes. As you correctly said, nothing is right or wrong. In the short term, one may look good, other may not look good. I think we have to look at our reality and how we can maneuver ourselves in the context of the market opportunity and play the game.
So
and we are clearly moving gradually into an activity-based pricing.
Got it. So digital capabilities building, digitally acquiring customers, moving to this from ad valorem to activity-based. So you're kind of now starting or will start looking a lot more like not the traditional broking service provider, but what is typically the app-based trading service provider. So my question is, as a strategy, maybe I haven't asked this to you before, but as a strategy, do you reckon that at some point of time, you as the head of this group would want ICICI Securities to look like a different player in X months or X quarters from now? Is there a target time frame in mind?
There is not even an iota of doubt in either my mind or anybody in my mind that we are here to transform ourselves into a marketplace, digital financial services marketplace, and we've set a vision out of 2025. That's the time frame we've set out. We've gone and told our investors that we are transforming to become a new marketplace, a digitally sort of powered open architecture marketplace, where you're providing all kinds of financial services across savings, investments, wealth management, across protection, insurance, across loans. So that's the journey, and it's all digitally powered.
Got it.
We are adding all digital properties one by one. It's just coming. And one needs to also recognize that whatever you launch is never a Taj Mahal to begin with. You have to keep refining. And that's what happens. And that's what is happening on an ongoing basis. And we are seeing results of that clearly.
So could FY23 as well, Vijay, be a year wherein you invest more in capabilities, product building, etc., and therefore results may be iffy in a quarter and good in another quarter? Could that be a possibility for FY23 as a year at large as well?
So, as a management team, we are seeing a kind of a once in a lifetime opportunity for this company, right? On the other side of that time frame, there are going to be a few players who are going to be becoming very large and playing the game in a digital. That clearly means that you have to invest in becoming like a potentially successful player of the future. This industry is an industry of cyclical periods in between. One has to be extremely clear that the medium term prospects are very, very bright, and a certain format of players are going to win in that future. So there is not even an iota of doubt. We are going to continue to make investments to emerge on the other side. And, beyond the point, getting too fussed about each quarter is going to sort of diffuse you from that longer path. Yes, there is going to be quarter, issues that we have to deal with as management team, as we are dealing just now. Sure. But, we are not going to move away from our resolve to march onward to that journey. And we are very, very confident that, that journey is what is going to win in the future. So we need to invest, and we'll continue to invest, and we'll continue to grow, and we'll continue to focus on quality, and we'll continue to focus on improving profits. That is what we are. So all input parameters is something that we will focus on.
Yeah. Well, the whole set of questions that I've asked, Vijay, is largely from a shareholder's perspective, right? Because they've had that tremendous time with your stock in the run-up to FY21 and then it's been a year of consolidation while some others have probably done really well. So that's where I come from. My final question, Vijay, really, and that is something that is you enjoy quite admirably compared to others, which is the high operational metrics that you enjoy and you continue to maintain. Even this quarter, I saw a very small slip on the overall EBITDA, right? But you are talking about higher investments. You're talking about maybe yields coming off, maybe revenues per se coming off from your traditional bastions too. Where do you think you would end up as a sweet spot? Let's say 2 years from now, when the high phase of investing comes off, even if you continue to invest, the high phase of investing comes off, where would you rest from the current 60% if I'm not wrong?
You're talking about cost to income ratios.
Sorry, no, that too, you've gone up to about 49 if I'm not wrong in this quarter, right? Unless I'm very wrong, your cost to income ratio went up to about 49 from 43. That's what I heard you say.
Correct. That's
right?
correct.
Yeah, but when I look at your margin performance, Vijay, that's the point I'm trying to make. That where do you think you settle compared to where you are right now? Because when I look at there's a difference, right? The EBIT margins that you enjoy, 61% this quarter, and a marginal slip there compared to most of the other players, at least 2,000 basis points below you.
Yeah, so our EBIT margin, that's not the way we actually look at internally. We look at cost to income ratio. If cost to income ratio expands, you will see an EBIT margin reducing, and obviously when it goes down, you'll see an improvement. In the post-investment phase, which is what you're asking, certainly we would expect a deceleration or a reduction rather on the cost to income ratio towards our guided number of around 40. And once that happens, I think there should be an automatic stabilization or expansion of EBIT margin.
Okay. Well, Vijay, thank you for this conversation. It explained a lot about how you're thinking about the business, and we wish you all the best on this journey, and stay safe, more importantly.
Thank you so much for having me on this show, and wish all the viewers thank you for hearing us.
No, the pleasure was ours, and the pleasure was of all your viewers and investors. Thanks for tuning in today. Viewers, thanks for tuning in.
Yeah, good day.